Thanks for joining us at XM.com for this special report. I'm Christina Marujos. With me today is Senior Investment Analyst Mario Hadjikyriacos. The threat of rising interest rates has returned to haunt stock markets, Marios. With the Fed going to war against inflation, we have seen a sharp sell-off since the beginning of the year, and volatility has gone through the roof. Is the market headed even lower, or are we going to see a classic comeback?
Hello, Christina. Well, that's a crucial question. I'm going to give you both the good news and the bad news, and you can make up your own mind about where the market is headed. So you're absolutely right. We've seen a very sharp sell-off since the beginning of the year. It really comes down to investors positioning for higher interest rates. Now, the biggest casualties have been tech and growth stocks, essentially, because higher interest rates tend to inflict the most damage on companies that either don't have profits or are barely profitable, right? So anything with an expensive valuation has gotten decimated lately. On the bright side, I think there are several reasons to be optimistic here. Now, the first and the most important one, the global economy is still pretty strong, right? What we've seen lately, it wasn't really a reaction to changes in economic fundamentals, but rather it was traders just pricing in tighter monetary policy, essentially, precisely because most economies are strong enough to handle higher rates. In that sense, in fact, investors may have gone too far already. So the markets right now are pricing in 5 to 6 rate increases by the Fed for this year. That's probably on the optimistic side of what is possible, right? There's a real possibility that inflation will peak in the coming months. We've got government spending fading, supply chains are slowly coming back online, and base effects are going to kick in from March onwards. Once investors see the first signs that inflation has peaked, I think they could dial back these ultra-aggressive bets for rate increases by the Fed. And that could push yields back down. That could help the equity markets come back. Now, politics points to a similar conclusion. The Democrats are probably going to lose Congress in November. So that means, yes, less government spending, but also no chances of tax increases, which is really important for stock markets. And another encouraging sign I'm seeing is a lot of the excesses in the market, a lot of the most speculative, bubbly areas of the markets have been washed out. So the companies trading at crazy valuations, the meme stocks, SPACs, pandemic winners. Just look at Zoom or Peloton, companies that did really well early in the pandemic. Those have fallen 70% from record highs. And even quality companies like Netflix or Facebook have gotten caught up in this storm. And the final element is buybacks, right? So last year we had a record year for corporate buybacks. Now, when corporations buy back their own stock, ultimately pushes stock prices higher, essentially. And with most stocks now trading lower than they did last year, this process could accelerate, right? And that is a consistent and powerful source of demand for the markets. Now, there are some risks as well, obviously. Now, the biggest downside risk, I think, is that inflation remains persistently high. Even after the supply chains come back online, if inflation stays around 4 or 5%, that could lead the central banks to go even harder with rate increases. And it would be really bad news for the stock market because it could propel yields higher and it could generate fears about a policy-induced recession. Now, the other big risk, I think, is that now that government spending is fading, economic growth might slow down dramatically, and that could also spark fears about a recession. Now, on the bright side, if this plays out, some of the negativity would be negated because the Fed would not go very heavy on rate increases, right? If there's a real risk of a recession. So that could offset some of the negative impact in the markets. And we also have geopolitics back on the radar. You've got tensions around Ukraine, around Taiwan, but generally the markets don't really care about those as long as it's just political muscle flexing, let's say.
That's very interesting, Mario. So bearing all of this in mind, can investors take advantage of all this volatility?
Well, I think so, Christina. I think volatility is going to become a more frequent phenomenon this year. The markets are going through a painful sort of readjustment period. They are learning to live without the support from the central banks and from the governments. And that implies a more unstable sort of environment. I think you're going to see higher volatility and sharper drawdowns overall playing out in the markets. Now, the good news is that the economy is not falling off a cliff. The economy is actually still pretty solid. And the markets might already be a little too aggressive with how many rate increases they have priced in. Combine that with the fact that buybacks are probably going to remain a dominant force in the markets, I think that investors can actually take advantage of the volatility. So if the markets start panicking about tighter policy and decline very substantially, investors with a longer term time horizon can take advantage of that to scale into positions for the long term, essentially, preferably in high quality companies. So the bottom line, the markets are going to kick and scream, but as long as a recession is not imminent, I think that they can handle slightly higher interest rates.
Marios, it was great having you with me today. Thank you for watching this special report here at xm.com.